What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%.
Alright, in what ways have high rising interest rates changed your life and perspective on the US economy? Come along with your answers. The current high rate environment is advantageous to savers because with a little shopping, they can easily earn 5% or more on interest on their savings. Because the Fed appears to be dropping interest rates this year, savings yields are already beginning to decline, which emphasizes how important it is to compare rates. Interest rate changes can affect the markets in both positive and negative ways. In reaction to changes in the economy, central banks frequently adjust their target interest rates, hiking them during periods of excessive economic expansion and reducing them during periods of economic contraction. The federal funds rate, which is determined by the Federal Reserve Board of the Fed and affects the whole economy, is the target interest rate at which banks and the US borrow and lend money to one another. A change in this interest rate typically takes at least a year to affect the economy broadly, although the stock market normally reacts to a change more quickly. The Federal Reserve is also determining the discount rate, or the interest rate that it charges banks that borrow directly from it, in addition to the federal funds rate. In part, this rate is typically higher than the target federal funds rate, which encourages banks to borrow money at the lower federal funds rate from one another. Investors can better appreciate how changes in interest rates may affect their investments by knowing the relationship between the stock market and interest rates. Additionally, they can better equip themselves to make wiser financial choices. What occurs if the real interest rate in the US declines? The supply of loanable funds declines when interest rates decline in the US, making local assets like bonds and returns on savings accounts less appealing to citizens of the country, as well as those who live abroad. The federal funds rate is the interest rate that moves the stock market. The interest rate charged by banks.
The Federal Reserve is expected to announce another round of interest rate hikes tomorrow. This comes amid growing calls for accountability after several banks collapsed earlier this month. That includes First Republic Bank, which is seeing major shifts in its stock price amid a bailout from rival bank.
Credit unions, savings and loans, and depository institutions to each other for overnight loans is known as the federal funds rate, while the interest rate charged by the Federal Reserve banks when they make overnight loans to depository institutions that are collateralized is known as the discount rate. In order to keep inflation under control, the Federal Reserve modifies the federal funds rate. The Federal Reserve is essentially trying to reduce the amount of money available for making purchases by raising the federal funds rate. Consequently, obtaining money becomes more costly. On the other hand, the money supply rises when the Federal Reserve lowers the federal funds rate. This lowers borrowing costs, which stimulates spending. Other nations' central banks operate in comparable ways. How do interest rates impact consumption? There is a chance that the borrower won't pay back the loan on every occasion. There needs to be a reward interest for lenders to take that risk. The money that lenders receive when they make a loan that the borrower repays is known as interest, and the percentage of the loan that the lender charges is known as the interest rate. Borrowers might spend money right away rather than waiting to save it for a purchase because interest is charged. People are more likely to borrow money to make large purchases, like cars or houses, when interest rates are lower. Lower interest rates provide customers with more disposable income, which can lead to a spurt in economic activity across the board. Lower interest rates are also advantageous to businesses and farmers, since they incentivize them to purchase huge pieces of equipment because borrowing is less expensive. This leads to an increase in productivity and output. Higher interest rates, on the other hand, reduce customers' disposable income and force them to make expenditure reductions. Banks make fewer loans when lending rules are tightened and interest rates are raised. Customers are not the only ones impacted by this. Firms and farmers who reduce expenditure on new equipment experience slower production or even layoffs. Consumer spending will decline as a result of the stricter lending requirements. which will negatively impact the bottom lines of many firms. Investors frequently select the option that offers the highest interest rate of return when weighing the average dividend yield on a blue-chip stock against the yield on a T-bond or interest rate on a certificate of deposit, a CD. Because it influences the return of both CDs and T-bonds, the current federal funds rate often influences how investors allocate their capital. What is the importance of the term federal fund rate? The federal funds rate is a term that's frequently used to describe changes in interest rates. This is the interest rate at which banks lend money to one another. It is used as an indicator to demonstrate whether interest rates are rising or lowering because it is subject to daily fluctuations that impact all other loan rates. Both recessions and inflation may be impacted by these adjustments. The term inflation describes the gradual increase in the cost of goods and services. It is the outcome of a robust and healthy economy. But if inflation is not controlled, a considerable loss of purchasing power may occur. The Fed keeps an eye on inflation indicators, including the Producer Price Index, PPI, and the Consumer Price Index, CPI. In order to keep inflation under control and contain price hikes, the Fed will raise the federal funds rate when these indicators begin to climb by more than 2 to 3% annually. People will soon start cutting back on their expenditures since rising interest rates equate to increased borrowing costs. After that, there will be less demand for goods and services, which will lower inflation. This was evidently the case in 1980 and 1981, with 14% inflation. The Federal Reserve increased interest rates to 19%. This resulted in a terrible recession, but it also stopped the nation's skyrocketing inflation. Similar to this, the Fed has been raising rates all year long in 2022 to counteract the rising inflation. On the other hand, declining interest rates have the power to end recessions. People are encouraged to resume spending when the Federal Reserve reduces the federal funds rate because borrowing money becomes more affordable. An excellent illustration of this was when the Federal Reserve's 2002 reduction of the federal funds rate to 1.25%. This had a significant impact on the 2003 economic rebound. The Fed can reduce the severity of recessions and stop runaway inflation by adjusting the federal funds rate. What impact do interest rates have on the US bond and stock markets? Companies find it more costly to raise financing when interest rates rise. For instance, the interest rates on the bonds they issue will increase. Raising the cost of capital could have a negative impact on both short-term earnings and future growth possibilities. As a result, future profit projections may be revised down when interest rates rise. In the event that a company is perceived as slowing down its expansion or becoming less lucrative due to increased debt payments or lower revenue, the projected future cash flows will decrease. This will bring down the price of the company's stock, everything else being equal. Well, that sure was a lot, but it's better now that you know now rather than later, right? If you like this video, give it a thumbs up. Make sure to subscribe to the channel and hit the notification bell to stay updated on latest content. Until next time.